Good morning, everybody. We're very excited to be here at our last webinar of 2021. We know that you are webinared out. You've had a lot of invitations from other people, so we appreciate that you're here today, and we appreciate the support you've shown us over the last years. We're also very pleased you're here because today's message is a really important one. If we look back over the past 18 months, we're very proud and pleased with the way that our investment team has managed all of our funds, from our fixed income funds to our multi-asset funds, our locally focused equity funds, as well as our global funds. Our positioning has really started to pay off, and sticking to our process is showing results. But we're far from complacent at the moment because there are very big shifts taking place in the investment environment, and we're going to talk about those today. We will continue talking about those at our physical webinars that we start having in 2022. These big shifts never take place in a straight line. They're often accompanied by a lot of noise and confusion. But at the moment, and what we want to demonstrate to you today, is there's a lot of evidence, facts mounting that gives us conviction to believe that these shifts are indeed taking place. What does this mean? It means that what's worked in the past, whether that is the safety of cash, real yields in cash, or the comfort of last decade's winners, may not be enough to reach your clients' goals in the future. So we see today as a crucial opportunity to share with you how our positioning and our approach is going to be a key aspect of your client's success in future. Our speakers today are Lyle Sankar and Anne Craig. Lyle is a CA and CFA charter holder. He's the lead fund manager on the PSG Income and Diversified Income, and both of those have done incredibly well over the last few years, and is part of our fixed income research team. He's been with the firm for 8 years. Anne is also a CA and CFA charter holder, and she's responsible for credit and property analysis. And you'll see in today's presentation that we've done quite a lot of work in property after not being invested in that sector for a long time. Anne has been with PSG for 3 years. So at the moment, we believe that fresh thinking is required across all asset classes. And we trust that today's presentation will highlight and expand some of these issues and will be of value to you and your clients going forward. Thanks again for your support and for joining us, and I'm going to hand over to Lyle.
Good morning, everyone, and thank you to Annette for the kind introduction, and thank you for dialing into our webinar today. So this is a fixed income roadshow, our final one for the year, and we hope to give you a good sense on where we see the best returns coming out of this market in the years ahead. So the theme for our presentation is, what if tomorrow looks different to yesterday? And when we consider the macroeconomic backdrop, we believe that the evidence is moving towards the world being a bit more reflationary in the developed markets. And then when you bring this back to South Africa, very important for fixed income investors, we believe we are more likely to see a subdued inflation environment ahead. And this has the consequence for a significant portion of the fixed income market where we believe performance in the asset classes you used in years gone by is likely to underperform going forward. When we look at the global macroeconomic backdrop, we think the clients are better suited in the multi-asset income space, where we think both the ability to benefit from potential tailwinds as well as use duration in a portfolio will set clients up for outperformance in the years ahead. So the same approach in our minds may not produce the same results going forward. So how we'll address this presentation and walk through is to start off with grounding the presentation in what your options are in the fixed income market. So what are the yields like, and what is the type of risk you've got to take to achieve them? So over the last 18 months, the repo rate has been at all-time lows, and there's been a big shift in the market. We'll talk about US inflation, and US inflation is quite topical right now, and what this means for markets and how we can interpret this as emerging market investors. We'll spend some time offering our views on why we believe the repo rate is likely to stay lower for longer, and then how that impacts portfolios and your asset allocation. And then we'll talk about bonds. It's not hard to convince someone that bond yields at 9 to 10% is quite attractive, but the key aspect is, how do we deal with the volatility in our portfolios, and how do we see that messaging to clients? Anay will come in later and she'll spend some time talking about property. Typically in the past, property was that boon for an income fund, especially a multi-asset income fund, gave you that little bit of extra yield. And so we'll spend a bit of time talking about how that can be used going forward and are there other options to get clients back to yields they were used to in the past. And then we'll spend some time at the end talking about our solutions to solve the gap. And in particular, we're quite excited about what we have in the space, how we are positioned for what can be a very different world ahead. So the local fixed income market, so what are your options? So simply put over here on this graph, what we have is yields versus duration risk. It's just one measure of risk, and it gives you a sense sort of what the yields have been back in the past. So we start with 2019. You could receive 7% from cash, 7.5% from a money market fund, and then in the interest-bearing market, being pure local fixed income portfolios with limited duration, you could build a very, very sleep, easy portfolio of a 9% yield and with very little volatility. As you move further to the right and you add a bit more duration risk, you enter into the multi-asset income space. We will spend quite a bit of time today talking about what are your options and what is the best way to structure a portfolio there. On the far right, we're looking at bond funds, and bond funds typically are invested mostly in government bonds, Eskom bonds, as well as Transnet and other SOE bonds. So this is the landscape in 2019, but obviously the repo rate cut has had quite a significant impact. And if you look at the repo rate, 3% lower since the start of the cycle, and we've only recently just seen a 25 basis point increase. So the gap is enormous on the front end of the market. And if you had chosen to be invested in cash over the last year, you would likely have returned roughly about 4% and a little bit more in a money market fund. As you move towards the right and you increase your allocation to duration and in the pure income space, the gap does close, but the gap is quite significant to where yields were pre-COVID. Where we believe the sweet spot for clients will be is in the multi-asset income space. We believe the gap is a little bit smaller there, and it's mostly due to the flexibility to use duration. Duration at the right point in the cycle can be quite attractive, and we think we are there today. On the far right, bond funds offer a great starting yield, but it's important to emphasize that bond funds carry almost 3 times the average duration that you'll find in a multi-asset income fund. And that means 3 times the potential volatility, which is a big concern for clients today. We'll focus throughout the presentation on the multi-asset income space, and particularly on our offering there. We believe the PSG Diversified Income Fund can close that gap even further. So let's start with the macro inflection point. And I think so much has happened in the market over the last 18 months, but it's important to look back at what we were for the last 10 years. So at PSG, we like to consider long-term cycles, and just looking back at the last 10 years, and if we were to classify the macroeconomic backdrop, we believe, South Africa experienced robust inflation, a lot of inflationary pressures offshore and locally, and globally, if you look at the inflation backdrop, it's been about 10 years of underperformance against the ECB and the Fed's target of 2%. So in our minds, we're in the top left quadrant, and we believe, the evidence, ways that this potentially has changed. So what worked in that environment? And we'll start with developed market bonds. It's quite simply put, as inflation falls or inflation is quite contained, you can continue buying developed market bonds alongside QE. And as these bond yields fall, you make continuous capital gains all the way down into negative real yield territory. Long duration equities, this we describe at PSG as equities that have the characteristics of low cash flow payback profile, so very long time to receive your cash back, either in dividends or other mechanisms, very high expectations, low earnings yields that have followed the developed market bond yields downwards, so high expectations for growth and high multiples at present. And these are the mainstays of a passive equity portfolio. Hard currency's done quite well in recent years, particularly the US dollar, as the Fed was the leader in terms of normalizing rates. And then bringing this back to South Africa, we think SA cash, corporate bonds, as I mentioned, a 7% portfolio, 8 to 9% portfolio from corporate bonds, very, very attractive and stable for investors. And then lastly, property. We think South African property, if you think just simply about rentals being linked to inflation, and inflation's roughly about 6% on average, you're getting a very, very attractive dividend deal from property. So these asset classes work really well, a lot of tailwinds for these asset classes. And on the other side of the coin is, those things that didn't perform very well. So we'll start with emerging market risk premiums. These have suffered in the last 10 years, so low developed market bond yields and low growth in emerging markets, and that has shown up in bond yields. We also believe that cyclicals and value equity, typically we can refer to them as short duration, where there's a lot of cash flow coming back at the investors, has also struggled. And then against the strong dollar, the rand has struggled, and SA GDP facing equities has also had a tough time. So this is the backdrop we've seen for 10 years, but we think the evidence is starting to grow that this might be changing. So let's look back at developed market inflation. And the simplest way to do this is to look at very long-term cycles of US inflation. So what we've got on the chart is US CPI year on year. If you look back at the last 50 years since the 1970s, we've only really had two peaks in inflation. They were very, very steep peaks, but the long-term trend has been for continuous disinflation. So inflation's been underperforming its targets for quite some time. If you look back at the long-term cycle, average inflation in the US was about 4%, but over the last 10 years, inflation has averaged about 1.87%, so very much underperforming. And we believe it's understandably that investors will struggle to believe there's going to be a change in the environment. If you look at bond yields track inflation with high correlation, and this, we believe, is the key point to discuss going forward. So on the right-hand side of the chart, we see the spike in inflation. A lot of the market participants believe that this is just due to short-term supply chain squeezes. We believe there's a lot more evidence that stacks to this inflation being a lot less transitory and a bit more sustained, higher than what we've been used to of just below 2% inflation. Now, if you look at the bond yields, the bond market is saying the correlation has broken down now, and the bond yields are not reflecting this environment going forward. So we'll start with US monetary policy and why we believe a subtle change last year will have long-term implications for inflation and monetary policy in the US. So Governor Brennard in September 2020 did a speech to the Fed, and the speech was about how the Fed will now respond in an era of low rates and low inflation. So a few key points was noted is that interest rates are too low, too close to the lower bounds, and no flexibility for another crisis ahead. The second point was that after a near decade of persistently short of 2% inflation, the Fed is struggling to get expectations higher. And then inflation is no longer sensitive to labor gains. So the typical Phillips curve relationship does no longer work. And four key changes were made, and we think these are going to be quite important for how monetary policy evolves in the years ahead. So the first was employment as a broad-based and inclusive goal. So in the past, we would understand that there was a neutral unemployment rate, and when we got there, this would typically start, to cause inflationary pressures. Now the target is much wider, and there is no specific number that the market understands is the driver of future inflation. The second key change was a move from 2% to average inflation targeting, critical move. It means that the Fed can now allow inflation to run hotter than the 2% target without having to respond immediately, and we think this is exactly what we're seeing right now. Both of these mandates will run in parallel, which means the market again doesn't understand which one is going to be more important, giving the Fed absolute flexibility. And then the fourth point, the Fed noted that financial stability is necessary for the achievement of statutory goals. Now, if we think about financial stability, we believe the Fed is much more cognizant of market valuations and are unwilling to disrupt markets. So not only has the Fed shifted the goalposts, they've widened it significantly, and we believe this is the reason why the Fed is very comfortable to allow inflation to run ahead of their interest rate or their policy tools. So let's look at monetary policy. Looking at the top left chart, so what we've got there is the real Fed funds rate. This is just the Fed funds rate, less inflation. And we can see on the right-hand side of the chart, it's deeply in negative territory, so roughly almost minus 6%. So we're running 0 to 0.25% interest rates, and inflation just printed at 6.2%. So deeply accommodative policy. And if you think about what the Fed did this month, they announced tapering without disrupting the market, and tapering will probably only end sometime next year, inflation dependent, which means that interest rates might only increase next year sometime, which means we're looking forward to negative real rates in the US for quite some time. The last time we've seen this was in the 1970s when we saw those massive peaks in inflation. If you add to that, on the right-hand side, the chart on the right is the fiscal policy setting. So it's the federal budget deficit as a percentage of GDP. So you can see on the right-hand side, we've had the biggest budget deficit since the 1970s. What's important here is that the keys are in fiscal policy setting hands. What it means is they can spend whatever it takes to get the US economy growing again. And in our minds, an expectation to revert back to balanced budgeting is highly unlikely in the years ahead. So if you look at what they need to spend going forward, we believe in combination, aligned monetary and fiscal policy speaks to a lot more inflation pressure going forward. So let's talk about wages. So we use a simple chart of wage pressures, unfilled job openings. So jobs created, unfilled. It's a key indicator in the US, and we believe the spike in jobs unfilled is not just the fact that people are still spending stimulus checks. We believe laborers are actually demanding a bit more wages to come back to the market. We've got a typical supply-demand mismatch where there's just a shortage of labor and high demand from corporates who are recovering from COVID. So we believe this is a pressure that we would not ignore very easily, and we think typically in the past, as wages rose, spending increased, and there was a further demand for higher wages, and we think this kind of pressure can continue, and we are seeing this in the numbers right now. The last point I would like to make on this is house price inflation, almost 40% of the CPI basket, 30% of core inflation. If you look at the shaded area, this is the price of the median house sold in the US, and you can see a massive spike towards the back end of the chart. And these numbers have not yet been reflected in the CPI basket. It happens with the lag. And so we believe this will come through, and this is a pressure that we are seeing. So in conjunction, we think there's certainly pressure in the US market for inflation to at least be higher than targets and to be sustained for quite some time. Now, we don't believe this is all a short-term squeeze in supply chains that's causing this. We think rather, if you look at what's happening in the commodity space this year, we think that's been caused by years of underinvestment in supply chains and a lot of demand that just outstrips supply at present, resulting in higher prices. So if you add to this, we don't believe that the Fed will need to increase rates very fast. We think they are happy to run behind rates. But what's going to also put pressure on the 10-year bond is the amount of debt they need to raise in the next year. So on this chart, simply put, the first 3 quarters of the year, the market had to absorb 162 billion in borrowings by the US Treasury, largely because the US Treasury had built up cash and QE was taking some of that from the market. If we look at the next 3 quarters, the market's going to have to absorb 1.5 trillion in US bonds in the next 3 quarters in order to service the needs of the Treasury. So the deficit, lower cash balances, and tapering results in more market borrowing. So simply put, at a 1.5% 10-year yield and a minus 6% inflation, we believe it's going to be very hard for the market to accept a low premium in order to absorb these bonds. So we think both inflation pressures will push the curve up if the correlations hold, and we think the supply in the market, like we've seen in South Africa in recent years, a lot of supply into the market keeps your curves quite high. So let's bring this back to South African monetary policy. I think we, over the last 10 years, has offered 2 contrasting income environments, and what we'll do in this chart is focus on the real repo, so the repo rate less inflation. And it's quite important. This is the SARB's key tool in order to stabilize inflation in the economy. So when you look at the period of 2010 to 2015, South Africa had twin deficits, a current account deficit, a budget deficit. We ran deeply negative real rates, and we had no growth spark. The result of this is rising inflation, and uncomfortable inflation for the South African Reserve Bank. If we look at the subsequent 5-year period, you had the opposite happening. So we had extremely high real rates, still no growth, but very subdued inflation. So in the first period, it's extremely hard for income investors because you don't have this real rate offering on the front end of the curve. You have to look at government bonds, and you have to think out of the box in terms of what you can invest in. We believe we're in a similar space, and it takes quite some time for the SARB to get back to normalized real rates. If we think holistically about this graph, if you view these shaded areas as the cost to the economy, so higher real rates are a cost to growth, to stabilize inflation, you can see clearly the peaks have been falling, and we think this is attributable to the Reserve Bank and their credibility about stamping out inflation and ensuring their independence. So let's look at what they've done for inflation. It's been subtle, but we think it's going to have significant impacts going forward. So South Africa's inflation, if you look back over the last 20 years since inflation targeting, South Africa's inflation target, the upper band was 6%, and the market is quite convinced that should be the range, and inflation will fluctuate around that point. We think the SARB, through their credibility, has managed to bring this inflation expectation down to 4.5%. Not only does the market see this, but price setting, using the last wage deal as an example, is closer to this mark now, and we think this is a credible target going forward. So what does that mean for bond investors is that you've got lower inflation, high yields, attractive real yields available for the market, so inflation-beating yields. The second angle to consider is the volatility of inflation. So if you look back over the last 20 years, in the early 2000s, inflation averaged between 0 and 14%. We then moved to a range of 3 to 7%, and we are now in a range of 2 to 5%, which we think is a very interesting dynamic going forward. What it also means is then your inflation target becomes a lot more reliable. Interest rates on the front end become a lot more measured in terms of where the cycle goes forward. So when we look at the latest increase in the repo rate of 0.25%, we certainly don't believe it's an indication from the SARB that we have to go in a rate hiking cycle all the way back to 7% and as quickly as we came down from 7%. We believe the dynamic and the credibility around inflation means the SARB doesn't have to get there, and that means quite a different environment for a large portion of the fixed income market. So where are we now? We believe the backdrop has changed. South Africa has moved to a more disinflationary environment, or at least contained inflation. The global backdrop is likely to be a bit more inflationary. And when we think about assets that perform really well, being beneficiaries in that type of environment we had over the last 10 years, we think some of the other asset classes, as we've seen this year in a reflationary world, EM bonds do quite well, cyclicals, value, short duration equities do well, and the rand, experiences a phase of more resilience. We think, we'd rather be balanced in our approach and consider allocations to these type of assets as well. So bringing this back to income investing in South Africa, we think using the same theme of what was the past winners versus what we think might lose going forward is quite topical now. So looking at this graph, what we have is the yields in 2019 in cash, money market instruments, NCDs being bank funding, and corporate bonds. Sleep easy portfolio of 9%. If you roll this forward, given what's happened in the repo rate, it's a lot harder to build a portfolio anywhere close to those yields without using government bonds. What we can do in this space is accept low volatility, but then at best get to a 5 to 6% yielding portfolio. So in our process, we've spent considerable amount of time working through our government bond thesis, and we think the thesis is quite solid at present. So if you look at the yields on the government bonds, it's equal, if not higher, than we had pre-COVID, and we think it's an attractive opportunity. Now, the problem with government bonds is a skew towards government bonds concerns clients that we are likely to experience a debt trap, And then secondly, it brings a bit more volatility given, it's quite a liquid market. So let's talk about the pillars of our government bond thesis, why we believe a debt trap is less likely going forward. So we think the simple pillars that you need intact is credible monetary policy. In South Africa, I think, as I mentioned, our monetary policy setting is world-class. You need prudent fiscal commitment, and I think this is the one we'll spend a bit more time on, given the changes to the minister. And then alongside that, that needs to translate into sustainable debt structure and costs. Now, for us, this pillar is where a lot of the damage has been done. So we are running too much debt relative to the growth levels in the economy. And then what you need alongside that is a liquid functioning market. So to avoid what happened last year in the heat of COVID, where the bond market blew out, we think you need a liquid functioning market, and the SARB has ensured that that would be intact. But ultimately, when you bring those first four pillars together, all of it leads to is an assessment of confidence, both local investors and offshore. And we think confidence in any metric right now is at all-time lows, because the market is concerned that we are not prudent from a fiscal perspective and our debt is unsustainable. But the reality is, if you add this all together, where you can really test the market's appetite for your investment is whether they are willing to supply you. So what that means is when you need to lend money, the market is there to lend the money to you. And if you look at the last year, South Africa excelled on all metrics. Foreigners returned to the market. Locals absorbed whatever needed to be, borrowed by the National Treasury. And we also managed to get, ESG-related funding. So South Africa doesn't have a near-term problem in terms of being able to supply yourself. There is no debt level that strikes you out as long as you can borrow from the market and these pillars remain broadly intact. We think, your thesis from a debt trap perspective is okay. The middle pillar we'll spend a bit more time on as well. We think it's quite important that, the market is quite pessimistic there, but these things can change quite quickly in terms of your debt metrics. So let's look at what actually happened with growth over the last year. So if you look at this chart, what we have is growth expectations for 2021. We'll start in Q4 2019. Growth is expected at 1.6, then moved a little bit lower in the beginning of 2020. And as we evolved through 2020 and 2021, you saw these growth expectations being increased and increased quite sharply, all the way to 5.05% towards the back end of this year. Now, these are the forecasts of the best economists on Bloomberg. How great would it have been to have known before the year that we'd be reaching a 5% real GDP growth? Our view is that it's absolutely impossible at times, and we'd rather take a balanced view on growth, especially when valuations are cheap. So this shift in growth was largely due to tailwinds from the changed macro environment. And so what does it mean for bond supply? As I mentioned, if everybody's willing to lend money to the government, you find in terms of your debt metrics. So what we have on this chart here is the rand amount, the rand billion amount that the government needs to borrow every week. So you'll see the spike in Q3 2020, where the government was expecting to have to borrow almost 9 billion a week from the market. But as growth was revised upwards, you can see how this supply dynamic changed quite quickly. So the government needs to borrow less and less as cash was collected, from SARS, revenue outperformed. And the result is the bad expectations we would have seen in the beginning of the year for net debt to GDP of somewhere in the 80% range, and there were forecasts of 90% plus, is actually lower, a lot lower, closer to 75%. So we think, slight change in the growth dynamics can have a big impact on your debt metrics, and we think, that will play through to confidence. But right now where we stand, the messaging is clear that South Africa is quite committed to debt consolidation. So how committed? I think there's two ways to look at it, is what's the message from government, as well as what we actually see in the budget. In the budget, we see consistency that they are looking to curb growth in non-interest expenditure. But just a few extracts from the latest budget. The large increase in debt has led to an unsustainable position. Stabilizing debt is essential. Progress in implementing reforms remains slow, and then, tax windfall will be used to reduce debt. So I think, these are quite important points. The messaging is correct, and we think, the budget was quite acceptable. The last point about revenues will not exceed non-interest expending from 2024-2025 is absolutely crucial, and this is based on a 1.7% outlook for growth over the next 3 years. So we think very much in line with expectations, the messaging is correct, and we believe this is still in line with government consolidating debt. So the second part of government bonds, if you're okay with the debt trap thesis, which we believe is intact, South Africa is not going to experience a debt trap. How do you deal with the volatility of bonds? So this is the 10-year government bond yield since 2012, so the last 10 years. And 2 points to pick out is what you don't want to do in bonds is buy in the 2012 area where bonds were between 6 and 7%. When bond yields move against you, that's when you lose money. And over that period, to 2015, just before Nenegate, bond yields were on a steady upward trend. What we do in our process is buy when we have sufficient yield above inflation and confidence around inflation. And so we became investors around 2015, 2016, and we've been investors in bonds since then. This has been very good for our clients, but it has brought an element of volatility to those holdings in the portfolios. So the simple way we look at it is, if you look at the last 5 years, the average 10-year bond yield was about 9.1%. So what that meant was, you buy in at 9.1%, every year you just keep rolling it into the 10-year bond, and on average, you earn that over the period. So what it means for investors in government bonds is that it's important to not consider the month-on-month movements, and as you extend your time frame, the volatility becomes less important because your returns tend to gravitate to where you buy as a starting yield. So we think, the volatility of bonds, we would prefer to deal with it in a portfolio, structure a portfolio well, rather than look, to the other asset classes where there's low volatility, but you're likely to get a portfolio of 5 to 6% yields. We'd rather be looking at these 9 to 10% yields if your thesis is intact. So let's look at the bond curve. We'll go back 2 years ago. On the side, we just have the bond yield and then, the term of the bond. 2 years ago, very, very attractive curve. An expectation of inflation around 6%, which means you had a margin of safety roughly across the curve of 3 to 4%. Very, very attractive pre-COVID. Where we are now is the bond curve has shifted higher. So from a valuation perspective, the bond yields are higher, they are cheaper. But what's important is this change dynamic in inflation where we believe 4.5% is going to be more credible going forward. And what that means is your margin of safety in terms of inflation beating yields has grown in our minds, and we think it's quite compelling. So if you look at the bond curve, what we're not advocating for is that investors need to be on the far end, the highest and longest bonds, or the highest yielding and longest bonds. We think at the 5-year point you can get 3 to 4% in real yield, so inflation-beating yields, and at the 10-year point, there's almost 5 to 6% inflation-beating yields available. Unlike a bond fund, you typically find a lot more longer-dated bonds in those portfolios. So very good real yields available, attractive starting point. And just looking back at the last 20 years of what that meant, we look at the correlation between, forward real yields, so the real yield you buy today, versus 3-year annualized returns, and the correlation is quite strong. So what that means is, the higher you buy as a starting real yield, the more attractive your subsequent annualized returns are. So where we are today, the real yields are somewhere in the range of 5 to 6% on a 10-year bond. That means, on average, in the past, you've earned between 9 to 12% annualized without fail. And we think this is largely due to the yields being very attractive on those 10-year bonds. So to summarize the government bond position, as you would guess, we're very excited about government bonds, but we aren't, forecasting blue skies here. So we'll take you through, just a few scenarios of what could happen to the bond curve of the year ahead. And we think the first is the base case for us, is that you earn somewhere around a 9.7% yield. If the market doesn't go up or down and it sort of averages around here like it has been doing, you're going to make about 9.7% yield, and cash is going to give you 4 and maybe a little bit more over the next year. So very, very attractive attribute. If we look at a scenario like we had last year in March, where the bond curve moves up 2%, we think, firstly, that that is quite extreme today. There's sufficient yield available in the bond in order to protect your capital. So you pretty much make almost break even over here on these bonds. And then in the right tail, we think there is a bull case scenario. Nobody's going to flag that growth is going to be higher in the next few years, and bonds, might revert to a more normalized level. But we think there is a scenario ahead, lower probability at present that bonds could be, 2% lower. And in that kind of scenario, you outperform even most equities from here. So we think, the probability is skewed to the right. We think it's less likely that you're going to lose capital on bonds, and there's sufficient protection within a 10-year bond alone to warrant a place and a large position in a portfolio. So if I could summarize before I hand over to Renee, I think it's quite important to understand in fixed income your performance might diverge going forward depending on how you are willing to use duration. We think in a multi-asset income fund where you are flexible in the way you can allocate to duration is going to be quite important going forward. So I'll hand over to Renee, and she'll talk through some of the other asset classes that we can use to complement this attractive fixed income portfolio. Thank you.
Thanks, Lyle. Good morning, everyone, and thank you again for spending time with us today. So what Lyle's done is shown you that we expect an inflection point globally, where we see structurally higher inflation on a global scale, but we expect the inflation profile in South Africa to be smoother than we've seen in the past, and that inflation differential between SA and the rest of the world to be lower than what we've seen in the past as well. And he's explained to you how we are constructive on South African government bonds, and that includes nominal bonds and inflation-linked bonds. What I'd now like to do is zone into the multi-asset part of our portfolios, those other assets that investors in flexible income funds have access to that we believe can serve clients well in this new kind of environment. So if we think of the typical multi-asset fixed income fund, that's a fund that is unconstrained in its bond position. It's also unconstrained in its credit position, so that's both government bonds and corporate bonds. And typically, these kind of funds invest up to 25% into listed property, up to 10% in local preference shares, and about 30% is allowable offshore. And typically, these multi-asset fixed income funds don't invest in equities at all. We think that this approach can lead to standard allocations within a fund, and that some of the assumptions behind those standard allocations can be quite dangerous. For example, considering equities to be too risky at all times tends to lead to a standard allocation to things like credit and to things like property. Now, listed property can behave very much bond-like, but sometimes it behaves like an equity. Sometimes the market prices credit risk, the risk of default, into the credit market, and sometimes it closes its eyes to that. So in the Diversified Income Fund, the PSG Diversified Income Fund, you can expect us to invest in property, equities, and preference shares up to 10% in aggregate, as well as corporate credit, when we find cheap assets at the right levels of risk. When we don't have to invest in any of those asset classes, and that has been the case in the past. So just to recap Lyle's point that the next decade won't look like the last, it's important to then recognize that the portfolio that you had in the last decade can't look like the portfolio that you need today. So what worked in the past, you had the declining bond yields, low interest rates, and low inflation. And as Lyle explained, long duration assets were favorable in that environment, as was cheap debt. So that worked two ways, globally and locally. All over the world, including in South Africa, you found balance sheets being geared up as they were fueled on cheap debt. And then also on a debt level in South Africa, we found that the corporate credit market was very cheap and a good place to allocate capital to, up to, we think, about 2018. But now in the new world of rising bond yields, interest rate increases, and where inflation is a bit higher globally and structurally, what is likely to work is short duration assets. So again, as Lyle explained, those are where the cash flows and total shareholder return is quite front loaded. And that can be in equities, or it can be something like South African government bonds. We have high starting yields and high coupons. The other points that you see on your screen there, high dividend yields, value stocks, resources or commodities, and real assets, can be summarized into one thing that will work: inflation protection. And now you're not getting that inflation protection from listed property anymore. So can you get sufficient inflation protection in your portfolio from government inflation-linked bonds as well as floating rate corporate credit, especially if floating rate corporate credit is quite expensive? And will you get that at the right level of risk? Potentially not. Potentially your portfolio will need to change, and we have to look at some other asset classes. So the beauty of the 3M investment philosophy and process, which long-term investors of PSG will be very familiar with, is that the process is consistent. The process doesn't change, but the outcome in terms of the securities and the types of assets that we like does change over time as the risk profile of these assets do change. So we aren't compelled to buy, as I mentioned, credit or equities or property in the PSG Diversified Income Fund. Our process allows us to weigh up risk-adjusted returns across these various asset classes and across our buy lists. And this can make us look different to peers at times. As Annette mentioned in her intro, listed property hasn't been a hallmark of our funds for a long time, and I'll tell you why it still isn't today. You could argue that we left money on the table not investing in property since the Diversified Income Fund's inception, and that's a time where the local property index returned 44% between September 2013 when the fund was launched and December 2017. But from a fundamental point of view, we believe that the sector was quite expensive at the time. And then finally, in 2018, the market agreed with us, and most of the gains that you made in the previous 4 years were wiped out in the subsequent 2 years of 2018 and 2019. But during that dip, we still didn't buy into locally listed property. And that was because we saw balance sheets as highly levered, and we saw bargaining power shift from the landlord to the tenant, putting pressure on rental growth and putting into question the inflation-beating nature of listed property. But then, of course, COVID provided what we really hope is a once-in-a-lifetime opportunity to buy into indiscriminate weakness, and that is when we started to invest in listed property locally. But we don't buy sectors. We select stocks based on a bottom-up process. So where we have invested in property, we've actually preferred global property, and specifically the US to South Africa. And what you can see on your screen is how the US property index has outperformed the South African property index during the time where our funds have been invested in the sector. But even so, we believe that our bottom-up process lends itself to select stocks that can beat the sector. Now, in hindsight, we would have done well to invest in Tanga factory outlets 3 months later than we did, which was January 2020. But still, Tanga is a great example of how our bottom-up stock picking process can yield sector-beating results for our clients. Tanga is a niche player in the US and the Canadian outlet centers market. And Tanga and Simon Property Group, which is another stock that we own, are considered the dominant two players in the outlet sector. So what the outlet sector is, this is an open-air type of retail where shoppers find premium brands at discounted prices, and it faces much less competition than traditional malls or department stores. And this open-air format has also proven to be quite resilient during a very tough lockdown trading period. On the local side, we've been very selective in the stocks that we like. We have bought into Resilient, and it's done really well for our clients since May last year, outperforming the South African property index by 18%. But Resilient hasn't always been a stock that we've wanted to own. So we've always thought that operationally, the management team is excellent. They really are best-in-class retail landlords. But historically, the stock was expensive, and we thought that earnings were on the frothy side. So we saw dividend yields were supported by things like finance income from employment equity schemes, where ultimately it wasn't always cash backed, and at the end, the BE schemes couldn't afford the loans that were extended by Resilient. And then on the governance side, there were complicated investment structures whereby Resilient had a stake in Fortress, but Fortress had a stake in Resilient. Both of these owned shares in Nepi Rockcastle, and then they sort of shared BE schemes that owned shares in both. And this led to a large degree, naturally, of uncertainty in the market, especially as to who was actually exercising control. And you can imagine that as an analyst, forecasting something like earnings was quite difficult at the time. But since then, Resilient's ESG profile has vastly improved in our view. They've made really credible changes to the board and to their governance policies. Those were strengthened, particularly where conflicts of interest and investment policies were concerned. That complicated structure that we saw on the previous slide has been completely unwound. They've proven that their dividends are now cash-backed, and they've vastly improved their reporting as well. But what really draws us to Resilient, the key attraction, is the location of its portfolios and the type of customer spend that it attracts. So it has a portfolio of peri-urban and rural retail centers in South Africa. And these are in places like what you have on your screen, like in Hammanskraal, north of Pretoria. There's Jubilee Mall or Jabulani Mall in the heart of Soweto. So you'll see that these centers are in places of high density, and or on transit hubs. And these type of centers sell the kind of products that people need as opposed to the kind of products that people want. And this skew towards non-discretionary retail has meant that Resilient has been able to outperform peers in a lot of trading metrics. And an important one is its ability to maintain and grow the level of rent that it receives from its tenants. So in the last year, Resilient has been able to negotiate higher rents for its retail portfolio at almost 2%. Now, 2% increase versus the expiring rentals feels really low. But if you look at the rest of the sector, they've had to revise their rents 12% lower. And if you take Resilient and its peer Vukile out of that South African property index, you'll see that rents have actually come down by more than 15%. So it's this type of dynamic that makes us believe that Resilient is well positioned to invest in that starting 9% dividend yield, and for that yield and for its dividend to actually grow more in line with inflation. And that's very different to our view of the sector. So while we like some property stocks, our property buy list is quite small, and we think that that low risk profile and inflation beating dividend growth characteristics that investors of property in the last decade were used to really is now more of the exception than the rule. So as I mentioned, we've got a small property buy list, and we actually see a wider set of attractive risk-adjusted opportunities for the Diversified Income Fund from our equity buy list. So as tough as the market has been, we do think that market conditions are highly favorable to build a classic 3M portfolio. One with high conviction, where we have high conviction in several great businesses where the market is underappreciating the quality of their franchises. And COVID-19 has provided long-term investors with a great opportunity if you are prepared to invest in areas that aren't popular. So what you see on your screen is we're trying to illustrate what a classic PSG 3M equity portfolio looks like. So in the first chart in the blue, you can see that our top holdings, where we have highest conviction on, have actually outperformed the market returns over longer periods of time, but have recently underperformed. And then if you look at the kind of quality, if we look at the chart in the green, we believe that these are above average quality companies with the ability to give us above average return on equity. And you can see that our top holdings, the long-term ROE of 18%, compares really well with the market's 12%. But the best part of this is that you can get these assets cheap at the moment because the market is still paying up for assets that worked in the last decade and isn't yet willing to pay a premium for assets that will work in the next. And then, of course, that was exacerbated by the COVID-19 impact, which we regard as temporary. So we do like high ROEs and we like low price to book ratios, But we are able to tailor the stocks that we select for the PSG Diversified Income Fund for the type of exposures that fit that fund's specific risk profile and its needs. So we like to gravitate towards stocks with strong balance sheets like the JSE. It has no gearing, but it has resilient cash flows. We like low price to earnings ratio like AECI, which is currently on an 8 times multiple. And it's also a beneficiary from the macro backdrop that Lyle sketched out for us. We like solid and growing cash flows like AB InBev. So AB InBev has a much stronger balance sheet than it did a few years ago when investors were very happy to pay 2,000 Rand for the stock. And it's trading at roughly 930, 950 Rand these days. And we also like attractive dividend yields like Exaro, which is currently on a dividend yield of 25%. So this is still a fixed income fund, but we find that adding equities like these with attractive characteristics of up to about 5% in the fund currently can really be very powerful when the stocks themselves have been de-risked and stand to benefit from inflation as well. Another asset class that is protecting our clients against inflation is preference shares, which you also like. And we like especially those counters that carry low levels of risk, and typically the banks. And we're getting a good, stable real yield of 2 to 3% from these preference shareholdings. And that's attractive enough as a base case. There's no reason to sell preference shares back when you're getting real yields of 2 to 3%. But if the stars do align and prefs are bought back at par, there is significant upside to our base case scenario. The preference share market is one where the size of your fund is actually quite important. So you need to be nimble in this market, and you have to balance the exposure so that you have enough preference share in your portfolio to be additive to the running yield, but you don't have too much so you're sacrificing liquidity, because this is a much smaller and less liquid part of the market. Now, if your fund is too large, you simply can't access enough preference shares to actually make a difference to your fund's yield. And again, if your fund is too small, it would contribute too much to illiquidity. So where the DI fund is positioned is we're able to allocate about 3.5% to preference shares, positively contributing to our running yield without giving up on fund liquidity. Now, the message of we like government bonds, we are constructive on duration, and we think credit is expensive is one that you've probably heard for quite a few months, if not longer, and not just from us. So that's really not a contrarian view. But what I'd like to show you now is some evidence in the market to show what people are really thinking about credit. So on your screen here is something called bid to cover ratios. What that means is we're measuring the appetite for a bond versus the supply that was available. So if a corporate wanted to raise a billion rand, it wanted to borrow 1 billion rand from the market, and it had there was demand for 1 times less than 1 billion rand, that bid to cover ratio would be 1 or less, and that would be a failed auction. That's a pretty bad outcome. But when there's really good and healthy demand, sometimes you get bid to cover ratios of 2 times. So there was, double the demand versus the supply. And that's, as I said, a really good and successful outcome. But you can see the dots on your screen, and what that picture suggests is that bid cover ratios in the last 2 years have been 3, 5, 6, and more times than the supply on offer. So that suggests one of 2 things. Either the market thinks that credit is actually really cheap, but that's not really consistent with the messaging that we've been getting. Or it tells you that the market knows that credit is expensive, but it is just a standard part of fixed income portfolios, so they're investing in it anyway. And we think this can be quite dangerous. Why it can be quite dangerous is because the risks have increased. So if we look at fundamentals, what you have on your screen is the probability of default of large SA corporates, and that's the line chart. So you can see how that PD has increased since 2016. What it means is that credit is more risky than it was in the past, and that the risk of a credit event or default has increased. But at the same time, the reward for investing in this now more risky asset class has been declining, and those are the blue bars. So you can see the real yield coming steadily down, and because of the interest rate dynamics that we've discussed last year, that real yield has actually turned negative in recent months. So this is a very important point where we have to remember 2014. Remember African Bank. Remember 2020. Remember the Land Bank. Spreads were tight, but the market kept buying. We had exposure to neither of these names in our fixed income portfolios, and it wasn't because we're clairvoyant. It's just because we saw the risks being built in the system, and the market wasn't pricing for it. So we were disciplined enough to sell before the credit events occurred. But when yields are low, you often find investors go into riskier and riskier credit. And when bid to cover ratios are high, and you see that investor demand isn't being met in the listed space, you also find that the incidence of structured products increases. And we saw just one of the big banks issue about 20 billion rands of structured products last year, and they set to issue quite a bit more than that this year. So we know that there is demand building for that kind of product. So I'll show you an example of one that came across our desk in the last few weeks. It's called an inverse floater, and it can be issued by any of the big 5 banks, so we'll just call it a Bank X note for now. And you can get it in any tenor that you want, but I've just put up a 3-year example on the screen. So you've got a 3-year Bank X note and a 3-year bank deposit as an alternative, or an NCD, and then you have a 3-year government bond, which doesn't actually exist. So that's an interpolation of the R2023 and the R186 for those checking up on me. But what the Bank X note can deliver for you is a yield of 1.5% in excess of these 2 alternatives. So that really does look like the clear winner, especially when yields are really low. That extra 1.5% is amazing. But of course, we have to look at the risk characteristics of these alternatives. So the 3-year bank deposit and the 3-year government bond are exactly what their names imply. So they have a duration of 3. So as you know, duration is a measure of interest rate risk. When interest rates rise by 1%, then the negative price impact on the instrument with a duration of 3 is 3 times that rise. In order to get that 1.5% extra yield, how the Bank X note is structured is it has a fixed rate deposit, and then you also have access to a receiver swap whereby you receive fixed rate interest and you pay floating. So just a little bit technical, but in order to get that additional yield, the size of the swap has to be 2 times the notional of your deposit. So there's a bit of leverage in there. And because you have two essentially swaps embedded in the note, the duration of this instrument is double what it is for the bank deposit alternative and the government bond alternative. So on a risk-adjusted basis, if we look at the yield per unit of risk, you don't get that 1.5% anymore. And you can see that you actually are getting almost 1% less on a risk-adjusted basis in the Bank X note versus the bank deposits. So the point here is that that is no longer the winner, but also that reaching for that extra 1.5% in a note like this may seem attractive, but it may not be the best allocation of risk-adjusted capital. The overwhelming majority of these kind of structured notes don't mark to market. So you see a nice stable yield, you see that nice stable extra 1.5% in your portfolio, and you also just see it as Bank X on your fact sheet. But if, for whatever reason, you need to get out of that note and you need to sell credit or create liquidity in your funds, you cannot escape the true duration of that note, and you will actually see that risk being portrayed in the note, which is, as Lyle alluded to earlier, higher duration, does tend to higher volatility and potentially higher downside than the alternatives. So again, the messaging for us is that when the environment is tough, we find that there is reaching for yield, and for us the bar is really high in terms of going into riskier opportunities as well as giving up liquidity. So just a reminder that we've seen the dangers of continuing to buy into an increasingly expensive market before, and we think that the environment is quite similar today. To bring this all together, how we blend these different asset classes into our multi-asset fixed income portfolio, the PSG Diversified Income Fund is heavily skewed towards assets that we liked. And those are the assets that Lyle spoke to, nominal bonds and also inflation-linked government bonds for that inflation protection element. We also like select equities, and we like preference shares, And as I've mentioned, we like some locally listed property. And that is the bulk of our portfolio. And then on the side of assets that we don't like is credit, as I've mentioned, and the credit that we own is predominantly Eskom government guaranteed debt, and we really see that similar to nominal bonds, and that's because of the strength of that guarantee and the easy executability thereof. We also have a profile of NCDs longer than 12 months, and that's bank deposits, and we're able to reinvest those and invest into higher rates that we see play out over the next 2 years. So we really back ourselves in our high conviction calls, and that's both in assets that we like, and we also know which assets we don't like. But this is a fixed income portfolio, and we're very cognizant of the risk mandate and not having binary views. So we try to incorporate ample protection through things like offshore cash and foreign bonds, which for the vast majority has been very expensive. So we've had very limited opportunities in that space. We hold a little bit of foreign bonds. We also have ample local cash, and we have some foreign property and equity exposure. So this measured risk approach, we think, is important in all of our funds, but particularly so in low-risk funds like the Diversified Income Fund. And though the portfolio is skewed towards the assets that we like, we do add that protection, and so that from a risk point of view, we feel that the portfolio is balanced and robust, and it is positioned for this changed environment that we've discussed today. So I'll hand back to Lyle now, and he'll speak to how this balance of risk has really worked in our clients' favor in recent history.
Thank you, Nave, for a fantastic summary on the other asset classes that we are using in these portfolios. So when we look at the fixed income market over the last few years, it's been great for fixed income investors, great returns. But what we have seen over the last year is a bit of a divergence, and we think it really speaks to the way that managers approach the fixed income basket, where they asset allocate to, and how they apply their risk management. And then secondly, as Ine mentioned, how do you apply the other asset classes that are available to these mandates going forward? So let's start with the results. I think we've been very, very happy with what we've produced for clients. On this chart, we have the performance of the PSG Diversified Income Fund in the black bar, the PSG Income Fund, the blue bar, inflation, which we believe is an important target for income investors, and then STEFI, which is a proxy for cash. So if you look at the income fund, I'll start there. We think the performance has been really consistent with what we'd like to do with the fund, is outperform cash without taking significant risk. And then secondly, the Diversified Income Fund, we've been really pleased with what we've seen there. All the asset classes and our ability to be flexible within fixed income and bring in other tools to perform well has really shown up in the numbers. So when we look at this going forward, we do think there's still quite a bit left in the portfolios. And what I'll do here is simply just look at what it means for different bond environments going forward. So like we saw in the previous slide, the left tail, the base case for bonds, and the bull case environment. So if we flex just the bonds in the portfolios, and remember when bond yields go up, that's when you lose a bit of money, and when bond yields go down, you gain through capital gains. So just starting with a base case, the bond curve does nothing over the next year. When I look at it today, the income fund can give you close to 6.5% as a yield, and the Diversified Income Fund close to 7.5%. If the bond curve does go against us in the next year, so the bond curve rises, you're going to perform somewhere near cash, just given the diversity within the portfolios and some of the other asset classes that can buffer this, this type of environment. But we think that's a lower likelihood of occurrence. And then in somewhere between the base case and a bull case environment, where the bond curve starts to reflect this normalized or new inflationary environment, as well as receive some of the benefit we've seen for emerging markets this year through a global inflationary backdrop, we think these portfolios are set to outperform both benchmarks, but give clients what they need in the income space. And if you look at all of these scenarios, these funds are likely to outperform cash over the next year, which means they've been constructed in a very robust manner. So to conclude in this, I think We've been very consistent in our implementation of our process. We like to be counter-cyclical, which means we'll get out of asset classes when we think they're expensive, and we'll act with conviction when we think, the market's quite cheap. And this has had proven results, and we think it's going to be important going forward. If we look at the landscape right now at the macro inflection point, we think the divergence in yield that you've seen in the local fixed income market can last a bit longer, and a greater focus on risk management is required. When you look at bonds, very attractive. We don't believe there's a debt trap on the way, and we think taking a longer term view and walking your clients through the volatility of bonds is going to be important. And then you need to act with conviction. I think, as I mentioned, in the multi-asset income space, we think that's the sweet spot for clients. We don't believe you have to go all the way to the right to a bond fund where you get a lot less diversification, a lot less protection in order to perform very well in the income space. And both these strategies are particularly well placed to deliver going forward. So the funds in aggregate, a very compelling opportunity set to generate attractive yields in a robust and risk-adjusted manner. So I'd like to thank everybody for listening today. We wish you a very blessed festive season, and be safe, and we hope to engage in the coming year. Thank you from PSG.